And what they're supposed to do is pay your mortgage. You've lost income. If you lost 80% of your income, their goal is to pay your mortgage. If you went ahead and became unemployed, the goal is to pay your mortgage. Why are we all flocking to this? Who here hasn't lost income? You haven't lost income? Okay. Yeah. I was going to say, I lost income. Everyone has. But you know what? What if this program can save us? What if we can avoid becoming delinquent? What if we can get a little relief? What if the federal government would pay our mortgage for 6 months and we never have to pay it back? Why doesn't anyone know about this? It's ridiculous. But the problem is that it's the same thing that we're going back to. The programs are failing. Out of the $1 billion received by the federal government, only 6% of that has been spent. Guess what? 6% wasn't spent on paying people's mortgages. 3.2% was paid on administrative fees. We still have hundreds of millions of dollars that are out there to go ahead and help people and pay those mortgages. In addition to that, 700,000 people in 2010 received a trial payment. You know, where you make that payment for the next 3 months and then ideally get a modification. Well, 700,000 of those weren't much of a trial payment. Well, it was either more than your original payment was, or you're talking about $10 or $15 less. The program is, in its entirety, a failure. And everyone realizes that. We have state senators that are trying to abolish the home affordable modification program. We have congresswomen and men that are trying to abolish the program, and for very good reasons. We're spending so much money, and we're seeing such little results. But what's good about this, though, is that it exists, and I'm completely against abolishing the one thing that has the ability to save us, and our economy. For every house purchased, it creates 1.5 jobs. For every refinance, you're creating half a job. So it all stems back throughout the United States, that is, as long as our housing market is working well, we're all going to get out of this recession. It's going to create employment. So, although the program's a failure, and in many eyes it is, there's many ways to work with it. And not, let's say, necessarily work the program, but work around it. All the programs, like I said, are based on guidelines. Guidelines that were established in the 1930s. Guidelines that were established by FHA. And guidelines that are supposed to make our payment more affordable. And I'll give you a perfect example. Let's go to the program that is most widely known and provides the most tangible results. The Home Affordable Modification Program. What is the goal of the program? Once again, as I keep saying, the goal is to reduce your mortgage payment to 31% of your adjusted gross income. So, we'll take my income. Let's say I make $1,000 per month. The goal of the program is fairly simple. It's to take my principal, interest, tax insurance, and homeowners association dues down to $310, 31% of $1,000. Simple, right? Okay. Now the goal of this, though, is not to necessarily say, okay, well, that's perfect, but how do I know that works for me? So how does the program actually work? How does my payment now go from currently $600 principal, interest, tax insurance, and homeowner associations down to $310? How are they going to reduce it? Okay? The goal is that they're going to do it in tiers, and they're going to do it in 3 tiers. The first tier, they're going to attempt to go ahead and reduce your interest rate as low as 2%. But I went from a $600 payment, now I'm down to $500. Still not affordable. The goal, of course, is to bring me to $310. Tier 2 is then they're going to take my interest rate, reduce it 2%, and extend my term over 30 years. What if I went from a $600 payment now to a $400 payment? Still not meeting program guidelines. Tier 3, well, who can guess what's going to happen on Tier 3? What are they going to do next to try to make it more affordable? Nope. We wish they would. That would just be way too easy. We'd all go walk out here, principal reduction, sell the house tomorrow, go on vacation. Yes, 10 years more than mortgage. Interest rate reduction at 2% over 40 years. Now, this is the kicker. Who here doesn't want a principal reduction? All of us most likely are underwater. Who hasn't lost equity in their home? Everybody, of course. And the idea is, yes, principal reductions. But the unfortunate aspect of it is 65% of U.S. citizens that have a mortgage are not eligible for principal reductions. Why is that? Well, who knows who Fannie Mae and Freddie Mac are? We all probably should. We hear them on the news and we bail them out probably once a year. We never hear about someone paying their mortgage to Fannie or Freddie. Fannie and Freddie own mortgage-backed securities. They own the notes. So while you're paying Bank of America is collecting $35 to $55 a month out of that as a servicing fee. And then trickling down there, the principal and interest that you're paying is going back to Fannie and Freddie. So what happens here is that Fannie and Freddie, the government-sponsored enterprises, say, we're not reducing principals, even though they're funded by our tax dollars. They say, no, we can't do it because if we do it for you, we're going to have to do it for everybody. And then also, let's keep in mind, FHA, USDA, VA, who write and insure 40% of these mortgage-backed securities. If you have an FHA, USDA, VA loan, you can forget about it. You can forget about getting your principal reduced. Why? Who is FHA? FHA is not a mortgage company. It's not a mortgage servicer. It's not a securities investor. FHA has turned out to become an insurance company. And what they do is they insure mortgage-backed securities. I'll give you a perfect example. Let's say I had a home and I owe $150,000 on it. It's only worth $100,000 today and I get foreclosed on. The bank, usually, in the cases you think, would write off $50,000 of those dollars. But when you have an FHA, USDA, VA loan, they're not writing off anything. They're collecting an insurance policy that basically pays them 80% of that $50,000 loss. So when there's an insurance policy that protects their best interest, and when you have a mortgage that's backed by Fannie Mae and Freddie Mac, principal reductions will not happen. So let's focus on the majority. And the majority is how do I go ahead and get the best deal, even though I may have a mortgage, government-insured mortgage, or my mortgage may be part of the GSEs, the Fannie Mae and Freddie Mac. The idea of the program is to get the best, most tangible results. So let's look at a real-life example. Okay, you have a $220,000 mortgage, including all the past due amount. Interest rate of 6.5%, escrow of $325. That includes your tax and your insurance, and a homeowners association of $125. Well, like most, refinanced 5 years ago, and I have 25 years left on my mortgage. So going back to the program guidelines, saying I want to go ahead and get the best mortgage payment. Forget about your income. Income's not important right now. We want to know what the lowest my mortgage payment can be. Okay? My income, my expenses, my assets, my liabilities, forget they even exist right now. What could potentially be the best outcome for you? Well, currently with this mortgage payment, including everything, my mortgage payment is $1,969.22. I need that lowered. I can't afford that. So what is it that I'm going to do? I'm going to try to work backwards and figure out what my mortgage payment would be based on Tier 3. I want the best results possible. I don't care how long my term is. There's no prepayment penalty. I can pay it off sooner than later. So I'll take that 2% over 40 years any day. So we'll go ahead and say, all right, Jason, what would your mortgage payment be at 2% over 40 years? Obviously, escrow and your HOA is going to stay the same. And I have a Fannie Mae backed mortgage, so my principal's not getting reduced. What it's going to do is take you from a $1,519 mortgage principal and interest payment to $681. Substantial difference. Of course I want that. I would love to go to $1,500 to $680. Your liability is reduced in total to $1,131. So now I know, at 2% over 40 years, I have a mortgage payment I can afford. Okay, this sounds good, but what do I do next? Any of us can go online, Google mortgage calculator, and find out what our mortgage payment would be. But what is the steps afterward? How do we get there? And this is a very simple process. The lowest mortgage your payment will be, and cannot be lower, is $1,131 off the scenario I gave. Can absolutely not be lower. So, using the simple formula, I already know what my mortgage payment is. $1,131. How do I find out what my income needs to be? Remember, like I said, your income's not important right now. We need to figure out what it needs to be in order to obtain this result. So working backwards, we're going to take 31%, we'll divide it by $1,131, and we're going to get our income necessary. $3,649. We're working backwards. Remember, we found out what our payment would be. Now we're finding out what our income needs to be. Taking the formula, 31% times your adjusted gross income equals a new mortgage payment. We figured out what the new mortgage payment is. Now we figured out what the income is. So do you qualify? Essentially, what the goal here is that we're trying to figure out what is needed to move forward and produce a result. The minimum income needed, which we found out, is $2,649. The lowest my mortgage payment can be is $1,131. Now, your expenses come into play at this. So now we figured out what the payment's going to be. What if I don't make enough money? What if I don't make enough money to even support it at 2% 40 years? Well, it's a very simple answer. You're going to rent a room. You're going to become self-employed and mow your neighbor's lawn. Whatever that deficiency is, whether it's $200, $300, and $400, you're going to find ways to make up for it. And the good thing about this is that the verification isn't really that much. If you need to go ahead and say, I need to make $500 more a month, you need to show $500 more a month in your bank account. And what are you doing for that work? Babysitting, mowing lawns, painting a house, whatever it takes, you're going to state that's what I'm earning the income from. Putting a profit and loss together, saying my total income's $500, my gross expenses are 0, my adjusted gross income is additional $500, gives us the ability to increase our adjusted gross income. Okay, now let's take the opposite example. What if I realize this and I make too much? The same kind of concept. If any of you look on your tax returns, your income will say adjusted gross. How do you get to that adjusted gross? You deduct expenses, medical bills, you deduct business expenses, job-related expenses. Well, you can do the same thing with your pay stubs to get approved. See, the process and the formulas are fairly simple and straightforward. Now let's take your expenses, for example. If you went to Bank of America, in this case my mortgage payment's being lowered by, let's say, $700. I went to Bank of America and I show a $900 deficit. Okay? If I show a $900 deficit, even after modifying, I'm still going to be in the negative, right? I want to go from a positive standpoint, or negative standpoint, to positive. We want to show the bank I can't afford it, and these are the reasons why. But by following the guidelines, I will have $200 left over at the end of the month. See, it's all fairly simple math. And the reality is you can't just go ahead and combine paperwork and supply it to the bank. It doesn't work that way. The video you saw before for the Hicksons, they did that for 4.5 years, and it just didn't work. But if you follow the standard guidelines and you put yourself in a position not only to get approved, but to see the most tangible results possible, you'll not only achieve success, you'll be able to maintain this property till you retire until you die. And that's the most important aspect of the American dream, home ownership. Our organization and what we do provides this guidance. We understand that bringing our friends here, the big banks, they're not going to be able to help the majority of you. But our goal is that if they can't, or if you just need that guidance, or if you realize that, wait a second, I don't have a plan, we can help provide you that. We also have our other friends, insurance agents, to help people get out of the forced place insurance. By the way, if anyone has forced place insurance, you can forget about a modification. Forced place insurance is when bank you haven't paid in, let's say, 6 months, your expiration date has expired with your current insurance policy. Bank of America says, well, we're going to place your forced place insurance on you. Well, forced place insurance is usually like 5 or 6 times more than the average policy, which is going to screw up all the ratios we just went over. And in doing so, the odds of getting approved just won't work, or when you get that trial payment, it's probably going to be more than what it was previously. So you need to have these steps and the guidance in order to achieve. And to be honest, anyone can do this. I understand trying to get a mortgage modification is like having a part-time job. We feel the stress just as much as you guys do. And my staff has all been through this. We're not new to this. We're all understand what foreclosure is, because the majority of them have been foreclosed on. We now are trying to figure out a way to revamp and help people re-understand the system. But more importantly, take advantage of what exists. So what I would like you guys to do is to go out there. You have the opportunity to meet with your banks. You also have the opportunity to meet with one of the staff members. If you wanted the opportunity to meet with me, not today, but if you'd like the opportunity to meet with me, you can schedule an appointment. You can actually come to one of our few offices in South Florida. That's about it. Does anyone have any questions?